Bonsoir tout le monde. Je suis Stéphanie Kamunya, chargée de projet pour le compte du Québec et pour le compte d'Alberta. Donc aujourd'hui, on va se rendre à notre traditionnelle séance d'information pour le mois de février qui portera sur l'impôt sur le revenu après le décès, Incoming Tax After Death, How to Plan. On aura notre intervenante Esther qui va nous expliquer de quoi est-ce qu'il est question et comment est-ce que cela fonctionne.
I want to thank, first of all, the government of Canada by funding this program. I want to thank our project manager, Mrs. Stephanie Kamunya. I want to thank you, Esther, for being here today to share this knowledge with us. The topic is very important because the death is part of life. And I want to thank also each of the people attending. I'm very grateful. So as the project manager was saying, we have to introduce you. So we have to read your bio. So I have it here with me. Esther Kamunya was born and raised in Kenya. She moved to Canada in 2004 with her family. Her love for nature spurred her education and career pursuit in ecology and sustainable management of forest and agricultural systems. Esther has worked as a teacher, a researcher, and an environmental. In 2018, Esther realized the intimate connection between consumer spending and environmental. Conversation with this realization and further inspiration by changing job market she made. Transition into a career in the financial service industry. Wow, what a big change. As a financial advisor, educator, and scientist, Esther's focus is in education of families and society. Globally, that is about you. Esther, if you want to add something else, feel free to do so.
So thank you so much for giving me the opportunity to speak about this topic and to speak to this group. I am very, very honored, and I feel very, very privileged to be able to have this opportunity to speak. This topic is interesting, as you have said, Harvey. It's a topic that we have to talk about. It's not a favorite topic, but it's something that is inevitable and we have to talk about. Thank you so much for the introduction and reading my story. So this is how I am going to give this presentation. And I'll just add a little bit about me, my story, my passion, and then we will talk about what happens to our money after we die. So in Canada, we are focusing on Canada, and we want to know, like, what happens? Is there a death tax in Canada or an inheritance tax? Who is responsible for paying that tax? What kinds of taxes can you expect after death? And then we can talk about how we can plan and how we can make it easy for those that we leave behind. My passion, you introduced like my career and education and career transition. Yes, it was a big transition, but I can sum it in, like, I think my passion is about living life in the most responsible way, but also living a better world for our kids. As you can see, I am married, I have 2 kids, now they are adults, but I have always been intrigued about how the environment is managed in a sustainable way. And as my story said, there came a time and I realized that we know a lot about how to manage the environment, but it's not being implemented. And the reason is it's all about money. And how people spend money has a very, very big bearing on how the environment is managed. So I took a transition and I thought that by combining those two things about my environmental management expertise and money management expertise, maybe I can help the society and families to live a better, sustainable life and live a better world for our kids. Now, today we are talking about a very interesting topic. And when people talk about death and taxes, this quote is very, very famous. This is Benjamin Franklin, a US president, a long time ago when they were implementing the Constitution. And the story goes that he was ailing himself, he was sick, and maybe that's why he had to talk about death and taxes. So he said something to the effect that the new Constitution is now established. And he said that everything is just about to become uncertain. And there's nothing really certain in life except death and taxes. And some people have taken this quote and said all kinds of interesting things. And I like this one because certain thing is death, taxes, and maybe people who are offended by everything. And these days, people are offended by so many things about taxes, about money, what do we do, what is the right thing to do. There's a lot of social media stuff. So it's good that we are talking about these things and putting some clarity. And then for me, I thought I should bring this scripture up because it also talks about death is certain and after that judgment. And today we are talking about how is our life on earth going to be judged when we leave this earth? How are we going to live the wealth, the taxes? How are we going to do to make sure that we are judged in the correct way? Now, as I said, there's a lot of things that are certain, including people who will be offended by anything and everything goes in this day and age. There's a lot of misconceptions. You will hear people talk about taxes. People don't like taxes when they are living. So you can imagine when they are dead. It's not a very good conversation. And so there's misconception about, is there inheritance tax in Canada? When you get an inheritance, do you pay taxes? Or when somebody dies, what happens? Do they pay taxes? How much do they pay? Who pays? Who is responsible for that? So we have all those questions, and I thought this was very good thing because some things like this trend. This was something that was tweeted that taxes are going to go up very, very much, and then it trends and trends and trends, and people are scared of taxes. And then there will be people going out there and telling people you have to do X, Y, Z, or rather you will pay a lot of taxes. So let's clarify what happens. Instead of going with hype, let's just know what happens. What's the truth? The truth is that there is no inheritance tax in Canada. So when you leave money and you leave it to your beneficiaries, they are not taxed. So what happens? You will be the one who will be taxed. The person who dies is the one that pays taxes on what they made throughout their lives. And so we started by saying death is certain and taxes are certain, as Benjamin Franklin said, but really taxes are not certain. They are optional. And there's a way to plan for it to make it even much, much predictable. So I have mentioned that the person who dies pays taxes, but the people who receive whatever the person leaves do not pay taxes. So the taxes after death, they depend on so many things, but the major ones are you married or not? So marital status means, are you married or not? And if you are married, the wealth you leave behind, there will be differences in how you are taxed if you are married or you are not married. The types of income and what kind of an estate you leave behind. So I'm going to dig deeper into that a little bit. But most importantly, what was your plan before you died? That will really, really make a big difference. And with proper planning, you could eliminate, like end up paying zero taxes if possible. You could reduce the taxes that you owe significantly, or you could actually pay for it, meaning you can arrange how to pay for your taxes when you are gone. So there's options. And the objective for planning is really to make sure that your beneficiaries, the beneficiaries are the people who you are leaving your money to, is to make sure that they receive most, if not 100% of what you leave behind. How does it work? How does planning of taxes after death work? Now, we all know that most of us are terrified by taxes. At least I was. Before I became a financial advisor, I didn't know what to do. I didn't know who to ask, and you just wing it. And I noticed that there's so many things I did not know. So if it's so difficult, even for us who are living, to file our own taxes, it's a daunting task. Imagine filing taxes for somebody you have lost, for a deceased loved one. It can be very, very, very difficult. So planning helps. And when do we plan? The best thing to plan is before, because if after death, then there is no plan, and it can be very, very taxing for the people left. Who is responsible? I think we can make it our own responsibility to plan. So before death, talk to the family, sit together, discuss how things are going to be managed, familiarize yourself with how to file taxes for a dead loved one. There is a lot of information in the CRA website, and it's very, very clear, but I think it's good for families to sit down together and learn how to do this before, instead of learning it when something has already happened. But at the same time, involve professionals, involve estate lawyers, involve financial planner, accountant, let them help you to plan. What about after death? It would be so helpful if after death or before death we have a will. So actually I should have actually before death, the part of the planning with the family is to have a will. Now a will, and this conversation today is not how to do a will and all that. I'm sure you have probably heard or maybe plan to have presentations where somebody just speak about the will and how to do it. But the will really is your voice after death. It's the one that speaks and says your wishes when you are already gone. It's almost like you're speaking, but you're gone. And this helps so much because in the will, you will have said who is going to be the executor of your will, but you have also given them guidelines of how everything will be done, what goes where, who pays for what, and all that stuff. So this is so important. Planning is very, very important, and we can do it right before things happened. So this is where we ended about planning. And so I want to go, remember here I said that how you are taxed depend on marital status, whether you are married or not, the types of income, and your plan. So I want to start with how different kinds of income are taxed. Mainly two ways. There's a terminal return, which is on the year that somebody passes away, an income tax return has to be filed. There are deadlines, so it's good to consult the CRA website, But usually, actually, the way it's done is that the tax return is due whether somebody is alive or dead. Like this year, we are doing taxes, and taxes will be due by April. So anybody who passed away in 2022 and is required, their executor are required to file taxes, with one exception. If somebody died past October of every year, so like we are filing taxes for 2022, somebody passes away past October, November, December, then you are allowed. You don't have to file taxes by April. You can file it 6 months out. But it's so important to know. It's a good thing to know so that people are prepared. Then income tax will also depend on, was somebody working or are they retired? If they were working, whatever income they had received, there will be a T4 for that person who has passed away. There will be employment income, whatever bonuses they had received, if they were self-employed, if they had sold a business or they had sold shares that they had invested in company, in stocks, anything that they had done that particular year, the tax year, that has to be filed as a return, and it has to be done within the deadline, and that's the income tax. The next one is the estate tax. Now think about estate tax as everything the person has accumulated over the years, all the wealth that the person has accumulated since they started accumulating wealth. So people usually have their homes as part of their wealth. They have properties, maybe they have rentals, they have cottages, they have investments accounts for retirement, such as the RRSP, a LIRA is a locked-in retirement income, or a retirement income fund, a TFSA. Maybe they owned a business or 2 or 3. Maybe they had an insurance policy, or maybe they had other non-registered investments like savings in the bank, guaranteed investments, equities like stocks, bonds, crypto, materials like gold, silver, whatever they had will all be put together, and then there is determination of how each of that category is going to be taxed. But all those things combine to form what they call estate. That is the person's estate, and then it's decided how it's going to be taxed. Now, how does it work? I'm gonna go step by step and say, what if you have this kind of income? How is it going to be taxed? So if somebody was an employee and they had made income, it's just gonna be taxed like a living person, just the way you would have been taxed. Employment, self-employed, interest on investments, if they owned a business and they had already taken out dividends. Throughout the year, they were taking out dividends. If they owned shares in public or private equity, they will be taxed. And then, number 2, if they had registered retirement accounts, like RRSP, RIF, LIRA, all that is deemed that they have withdrawn all of it. However, remember I said, it depends. Are they married or are they single? If they are married, all that can roll over to their spouse and it's not gonna be taxed. So a lot of times you hear people say, oh, if you have an RRSP account, it's not good because you're going to be taxed. Well, it depends. If you have an account and it's supposed to be your retirement money, you and your spouse, and God forbid, one of you passes away before the other one, then it means the other money is going to roll over to the other spouse. So it's a good thing to have this RRSP, because if you had saved a lot and the other spouse is left by themselves, maybe they can decide, you know what, the money that me and my spouse had is enough, and now I don't have to continue working again. So that can be almost like an insurance policy for the family. So it's very important that you know that if you have an RRSP or any retirement money, if you are married, it's automatically going to roll out to the spouse. If you have dependent children, it can roll over to them. If you have a dependent person with disability, it can roll over to them. However, if you're not married, you're single, or maybe your spouse preceded you and you have retired, maybe that would be the one of the options, is that you still have RRSP. If something happens to you and now you leave it to somebody else, not your spouse, not dependent children, not dependent person with disability, maybe your adult children or your grandchildren, that's the only way that all that money will be added to your income, and that will be taxed. But there's nothing to worry about, because we can plan ahead of time about that, and I'm going to demonstrate how you can do that. So let's proceed. Other types of income, if you have a TFSA, we all know TFSA is the tax-free savings account. So any money in a TFSA is not taxed. So that one, no problem. Principal residence, if you own your house, that's your principal residence, that's where you live, that's not taxed. But if you have other properties, they are deemed dispositioned. So it's almost like on the day that somebody dies, it's assumed that their property has been sold at fair market value, whether it's sold or not. It's almost like everything stops there, and the fair market value at that time, those properties are valued at that, and then the deceased, the person who has died, will be assessed taxes on any capital gain, 50% of that. So capital gain is like if you had bought your house 20 years ago at 200,000. So you paid all that together with interest, and now your house is 500,000. So most people will say, oh, I have 250,000 I made. Well, not quite, because you put in all that money, but there was taxes, there was other stuff. So really, the income you made is probably less than that 250,000. But you're not taxed on all the 250,000. You are only taxed on half of that. And that is added to your income and is taxed as capital gain. What if you had a business? The business also, you're deemed to have disposed the business, and it's almost like if you owned 100 shares of that business and you had invested some money, let's say you invested 100,000 to start your business, and now your business has grown to $1 million. So you have a 990 or 900,000 that is worth of that business. And now a lot of people say, oh my goodness, I'm gonna pay a lot of taxes. Yes, the business is deemed disposed. However, are you gonna pay taxes or not? There's something called a lifetime capital gain exemption. Now, we will talk about that, but I want you to know that there's a way that business taxes are done. So if somebody says you have a business, you're gonna pay a lot of taxes, well, there's a way to go about it. So I'm gonna come back to that again. But this is just how different things are taxed. Then the next thing, and this is the very interesting one, because we all know about life insurance, and we all know that our insurance agents, we sell a lot of insurance. We tell people buy insurance. you don't want to pay taxes, you don't want to leave your family in trouble. But let's think about how insurance policy works. So if you have an insurance policy, the person has an insurance policy and they die, they will leave a policy that has a death benefit. Death benefit is if you have bought an insurance policy for $500,000, that's the death benefit. The death benefit is paid to the beneficiaries tax-free. However, there are cases where insurance agents sell policies that also have a cash value. And they say, you know what? Why buy an insurance policy that you'll never get money? Take this policy, it will grow, you will invest money, there will be cash. Now, if you have such a policy, and God forbid, something happens, you need to know what will happen to the cash value. Here are general guidelines of what happens. But the best thing is to take your policy with a very, very good advisor, probably not the one who sold it to you if they don't explain everything. Get an objective analysis of what kind of an insurance policy you have, what will be taxable and what will be tax-free. If you have cash value there, but it's more than the cost base of your insurance, and that's complicated, it's better to look with a financial advisor. That cash value that is above the cost of insurance will be taxed. You have to know that. And then there's different kinds of insurance policies that have cash value, like a whole life policy or a universal life policy. But what's the difference? Again, if you have a universal life policy that you used to say that I'm doing this, a permanent life policy, because I want to take care of taxes. If you have something like that, remember again, anything that is above the cost of insurance will be taxable. But the gray area is whole life policy. If you have a whole life policy, let's say for $500,000, and it's been growing and growing, maybe you got it like 40 years ago, and maybe now it's grown and it has 100,000 or 200,000. What happens when you die? When you leave that policy to your loved ones, they get the death benefit. Any cash value there is almost like use it while you are living or you will lose it. So again, you have to review your whole life policy and make sure there is no, very, very few companies have a whole life policy that pays together the death benefit and the cash value. In most cases, the cash value evaporates and all that your beneficiaries get is the death benefit. So be careful about those concepts like insurance with return of premiums, insurance with cash return, or insurance with its infinite banking, or all that stuff. Make sure you are reviewing your insurance policy very well. So when we put all that together, so we talked about different incomes here and how they are taxed. But this is a summary because it depends with so many circumstances. Let's try and put it all together. I'll start by saying there is no one size fits all. Every situation is different and we have to customize a plan based on one situation. Your situation, my situation, somebody else's situation is very, very different. So let's put it all together and let's imagine, like, how do we plan for this? I will make a joke here that the best way to plan really is to plan for long life. This is the most probable outcome. And it's more important that we plan for if we live than we die. And this is a conversation for another day. But let's say you live a long life. Let's say you are a retiree, you worked hard, you accumulated a lot of wealth, you saved in your retirement, you have been taking that money out, what could you do? Number one, you probably don't have employment income, so you don't have to worry about that. You probably are taking money out of your retirement account. You have been in low tax bracket. That is most likely for most people, except a few occasions. But throughout the years, you are working with your financial advisor and you are planning your RRSP withdrawals, and you are planning them in a tax efficient way. You are planning, sometimes you can take a little bit more from your RRSP and roll it over to TFSA, roll it over to other things. You can even start transferring some of that money to your beneficiaries while you live. And how do you do that? You could contribute to your grandkids' RRSPs. You could buy them a life insurance policy. You could do a lot of things. So actually, where it starts is about starting to plan about life. And we will talk, maybe you guys, if you invite me another day, I can talk a lot about how you plan for this. Because this is how you avoid unpredictable taxes after death, is you plan throughout your life. Then what about other things? Well, you tell me, Esther, long life, that's a joke, but we can't predict death. We cannot. Yes, I do understand that. So how do we go about this? This is my philosophy and the philosophy of most financial planners. While you're still young, while you're working, while you have dependents, that's when you need a lot of life insurance. That's when you need enough insurance to cover any debt that you have, any mortgage, even to replace your income if possible. So if something was to happen in your 30s, in your 40s, and you have little kids, you have a spouse, this is when you need to have a lot of insurance so that you can make life easier for them. I almost get goosebumps when I see somebody has dependents, has a mortgage, but then they chose to get $200,000 worth of life insurance, and they made it permanent, and they're paying a lot of money. Why? Because, oh my gosh, I don't want to die and leave my dependents uncared for. However, because we cannot predict death, that's why we use term life insurance, because it's cheap. It's very cheap, and you can load enough insurance to pay off mortgage and to replace your income if something was to happen. And still from your income while you are living, you need to leave a little bit more to spend on protecting your income. What would happen, for example, if you are critically ill or you are disabled? We may think this has nothing to do with taxes after death, but this has everything to do with taxes after death, because the way you plan while you are living affects what you live after death. So if you plan like this, then it's good. And then whatever money that is left, invest that money in your retirement, because remember, I started by saying you are more likely to live a long life than to die. It's a delicate balance. So what I usually do is, when I sit with my clients, I look at their income, I look at their cash flow, I look at their expenses, and I want to balance that. They are protecting their lives when they are young and when they are working, but they are also saving some money to live off in retirement. And then we plan to be debt-free in retirement, because if you're debt-free, then you don't have to worry about that. And only buy permanent life if you truly need it to mitigate for taxes. And I am going to talk about that more, that you can use insurance to pay for your taxes after death if you know that you're going to leave a very big tax bill. And there's a way to do that. So something else, keep going about other kinds of estates and how it's taxed. Personal residence designation. If you have more than one property, Then you can be smart about how you designate which is your personal property. And it makes sense to designate the one that has most capital gain, because then all that will be tax-free. Now, the other thing is, if you have more than one property, you have rental income, you have all that stuff, consider having an investment company instead of personally owned rental properties. Why? Remember I told you a lot about the lifetime capital gain exceptions, and I'm going to talk about that more in a bit. If you have rental properties and you're using them for retirement, be careful about that and think twice and plan ahead. Plan very well so that you don't have retirement properties, you're getting income, but God forbid something happens and you die, then you leave a lot of property that are going to be taxed capital gain, and you don't have an investment company. So it's good to be planning about that. But also you can transfer assets before you die. You can actually literally start transferring some assets. You could have joint ownership. You could freeze some of the assets. There's tax efficient ways of doing that. If you work with professionals, tax lawyers, and financial planners, you will be able to do that. So the biggest one where you could have a lot of taxes is if you are a business owner. If you're a business owner and your business is accumulating a lot of money, and I like to talk about this especially with the younger people, 30 years, 40 years, they're in business, and at 65, 70, they will have grown a big business. You don't wait until there. You start planning ahead. However, this is where I talk about the lifetime capital gain exception, because if you leave a business, if somebody dies and they leave a business behind and you own shares, remember the example I told you about a business where it's worth $900,000. If you own a business that you're leaving behind and it's worth $900,000, ideally, only 50% of that would be taxable, and that's $450,000. However, there's something called lifetime capital gain exception, and every year it's an amount. I looked, and this year in 2023 is $913,630,000. This means that if a Canadian business owner leaves property that owe taxes up to $913,630, they will not pay tax. Why? Because it's exempted. So a lot of insurance agents run around selling insurance to business owners and saying, oh, you're gonna pay a lot of taxes. You're gonna pay a lot of taxes. But really, you have to leave a business worth so much, because 913 will be exempt. Meaning, if you have a business that is 1.8 million, you probably will not pay taxes. Again, it's good to plan ahead. There's other things you could do. So let's say you are building a business and it's growing, and you know for sure it's gonna be more. It's easy to calculate those taxes and buy something like an insurance policy that will take care of those taxes. If you own a business as partnerships, you can do a buy-sell agreement. So let's say you own a business with another partner and something happens, you pass away, you leave your family, but they are not interested in that business. How do they get out of that business? How do they get out of that partnership? Insurance can buy you out and then they get that money. And if you had the lifetime capital gain exception, you are not going to pay any taxes. Then there's other ways that are more complicated if you have a really, really big business, and that's estate planning, estate freezing, using trust, and using permanent insurance in lieu of trust. Now, I will go back again. Remember, we talked about how income is taxed, what kinds of incomes and how they are taxed. And we have talked about how you can, how can you plan? designating your principal residence, planning while you are living, planning your taxes, planning your retirement income, planning all that. When you do that, because as I said, you are more likely to live than to die. This is life expectancy in Canada. It's very, very high. It's projected to even be higher. So what should you be worrying about? Should you be worrying about life, or should you be worrying about death? And my principle is plan for life. And if you plan for life, and every year you plan, you will be able to plan for your taxes as well. Your situation is unique. Do not plan based on hype. When I sit with my clients, we calculate and say, what will be your tax bill after death? So for example, remember I told you that if you have an RRSP and you're single and it's not gonna roll over to your dependents, it can be taxed. But we can project, we can say, if you continue contributing to your RRSP like this, how much RRSP will you have at 65? $2 million, $3 million. What will be the tax bill? Maybe 100,000, 200,000, I don't know. Then let's calculate that, let's determine that, and let's put in a life insurance policy that will take care of those taxes. I hope this makes sense, that you're not doing hype. You're not following people who say, buy life insurance because you need to protect yourself against taxes. You need to protect yourself against this. Don't buy out of fear. Calculate, project the taxes, plan ahead. Monitor and review your plan with your financial advisor every single year. It's a lifelong process. And when you do that, you will not have a problem with taxes after death that are not planned. Here is something else to think about. You can use life insurance to mitigate against taxes. However, you need to monitor that very, very well. Because if you don't fund it well, you might end like in your 80s, and then the insurance company comes and says, you know what? That permanent life insurance you have, it's gonna lapse. Why is it gonna lapse? Because it's not well funded. So again, you may have something that you think you had, but you still leave your loved ones in trouble because it was not being reviewed. So it's so important that it's being reviewed every single year, and that is being changed accordingly and according to how needs are changing. Now, this is one of my favorite slides to show, because it shows that for us to be able to plan for taxes after death, we have to have done a good plan to plan for when we are living. And there's no one size fit all kind of a thing. We have to build a customized financial plan for ourselves that suits our needs. And this is just my theory of how to go about it. First of all, take care of things that you cannot control. Premature death, unpredictable death. Does it happen? Yes. Illness? Yes. Disability? Yes. Let's first take care of that in the most efficient and economical way possible, so that we may leave money behind to do all these other things, to save for our dependent kids, to save for emergencies, to reduce our debt load, to educate our kids, to pay off our mortgage, and most importantly, for what we are going to live off when we live, because most of us will live a long time. These are things that are within our control. The things in orange, those ones are within our control. We can plan for them. The ones in red, they're not in our control. We can pass those risks on to insurance company. But let's not pass on more risk than we should, because the more risk we pass on to them, the more money we pay for it. And then finally, there's the green, where we want to go up there on the pyramid. Those are the growth opportunities. Those are when we own businesses. Those are when we want to preserve an estate and maximize our wealth. This is where permanent life insurance comes into place, because now you know you are going to leave a little bit more wealth that might accumulate a little bit more taxes, and so you need permanent life insurance to pay those taxes. So again, we need to do this not by hype. That's what I'm calling practical faith. We need to do it with the financial coaching, with a good financial planner, and review your plan every single day. We can use insurance to mitigate some of those risks, but plan, plan, plan. That's the answer. And as I said before, my presentation is usually short. That's it. But I really wanted to, after I present this, then we can open up for more conversation, questions, clarifications. And this is how to reach me. As you saw, I just presented a lot of things. I didn't give details because, again, it depends with every unique circumstance. So if anyone wants to reach out to me, that's how to reach out to me. You can take a screenshot, you can write it down, and I am very, very, very grateful to this opportunity to be able to speak to you. And I open now the floor back to you, Harvey, for questions.
What a wonderful presentation. Thank you so much, Esther.
You are most welcome.
Ok, ma question est celle de savoir, parce que j'étais tellement intéressée par comment les taxes sont gérées ici. Et je voulais savoir si c'est tout le Canada, le processus qu'elle a décrit dans les 2 diapos, how to tax work. Comment est-ce que oui, ces deux diapos-là, ça m'a vraiment intéressé. J'ai pris vraiment en considération. Et je voulais savoir si c'est partout au Canada que ça fonctionne comme ça.
So here's the question of Henriette.
Mm-hmm.
You show us 2 diapos that she's very interested in, talking about how the taxation, how it works.
Yeah. Mm-hmm.
So she's asking if the scenario that you took is from all the Canada or just in Alberta. So this is related to all the country, across the country, or just here in Alberta?
Actually, it's Canada. What I did not do is I did not go into details of what the taxes are. Like, for example, it will be different in Quebec, especially Quebec compared to the rest of Canada. Mm-hmm. There's a few differences there. So I didn't go into the specifics. And then when somebody dies and there's taxes to be filed and there's an estate, there's probate fees. There's the fees that people pay to file those and to execute the will and all that. And they are different in different provinces. Some especially Quebec, I think is cheap. Alberta is very cheap, but some places like in Ontario is very, very expensive. BC is very expensive. So I did not go into those specific details. But the general way of how things are taxed, income tax, property taxes, business taxes, is all the same across Canada. It's the same way that every year all Canadians are filing their taxes. That's how, when somebody dies, that's how their taxes are filed. So their income taxes will be filed exactly the same way. The tax bracket will be the same way. Everything will be the same way, except because now there is an estate, because now this person has died and everything that they have accumulated, including the things that were not being taxed before, now have to be taxed all at once. That's the difference. So what usually happens is now the tax bill is higher because, for example, if they had properties, those properties were not being taxed because normally they are not taxed until they are sold. But now that somebody has died, it's assumed they have been sold. If they had a business and the business has accumulated a lot of wealth, it's usually not taxed. However, if they die, now the business is deemed as sold and they have to be charged taxes. So that is the difference. And that's the one I said the best way to plan is to make it a lifelong process. It's not something you say, I'm just about to die, let me plan for my taxes after death. It's something you start planning, or every single time you're doing your taxes, plan with a tax planner. Not an accountant, but a financial advisor will help you, because every time you will look and see what might be my taxes if I were to die today. What might be my taxes if I were to die 10 years, 20 years? You can always project all that, and you can estimate what the taxes were. So I did not go into the specific, the general ideas I presented are applicable across Canada.
Thank you.
You're welcome.
You mentioned the fact that for a business, right? If a business grows from 1 to 100, and something happens, there'll be a taxable, so it would depend on the value of the business.
Mm-hmm.
So my question regarding the value of the business is it the cash that is in the bank account, or the value of the business, meaning like all the assets, like even the building, if the business owns the building? Is that what you mean, or just the cash value part?
Everything. So what happens is, if you have a business, let's say you are running a business and this is tax season, so every business owner will file taxes, their personal taxes and their business taxes. So what usually happens is that all the revenue you brought goes on one side. All the expenses you incurred to produce that revenue goes on the other side. If you spent more than you made, then you made losses that year. If you spend less than you made, then you made profit, and you pay taxes on those profits. Mm-hmm. And then there's money that is left. What do you do with that money? Maybe you invest. The company owns property. The company owns other things. Maybe they even invest in stocks and all that. When somebody dies, now the business value is everything. It's everything that is assessed, and it's based on your shareholding. So if you own 100% of the shares and the business is worth $1 million, then this is what CRA will look at. Your business today in 2023 is $1 million. How much have you invested to build that business? Maybe they say you had invested $300,000. So that is your cost base. So your capital gain then is $700,000, because your business is $1 million. Your cost base is $300,000. So you have made over the years $700,000. That's your capital gain. How are you going to be taxed? Half of that, because remember, capital gain is 50%. So small businesses are never taxed on 100% of what they have made. So only $350,000 would be taxed. However, if you have never used your lifetime capital gain exception, at that time, the person filing your taxes can say, you never used your lifetime capital gain exception, so you can use it and you will pay zero taxes. Does that make sense?
In the pyramid that you show us, you mentioned that at the end, which is on the top, you the best strategy might be to have a whole life. But prior to that, you say that whole life with a cash value can be taxable if you pass away. This is a little bit confusing because if you make money when you're growing, it means that if you acquire a whole life policy when you are a certain age with enough wealth, then your cash value will be higher, right? So how do you, I'm really to be confused with that strategy.
So I said permanent life insurance. I did not specify whether it's whole life or universal life. It could even be a permanent life insurance without cash value. So we have permanent life insurance, which is called a T100, that doesn't have cash value.
Yes.
Then there is whole life that has cash value in a different way than a universal life. So when you go to that pyramid on top, and you know you are going to probably leave more wealth, and you need to mitigate for taxes, then now you have to be looking at those options. But which option is best for you? It depends. That's where I say unique situation. I cannot say go get a whole life or a universal life or a term 100. I can only say let's look at your situation and what would be the circumstance that you get a whole life. Now, remember, in most cases, business owners are sold whole life policies by insurance agents at an earlier age. And that might make sense because if a business owner needed to borrow cash from that whole life policy, then they can do it. But if you are doing it solely for tax paying, maybe it's not the best option. What I wanted to emphasize is that you have to be very careful with the whole life policy because no matter how much cash value is there, when somebody dies, only the death benefit pays. So it has to be used for a different purposes, but not as a death benefit kind of a plan. Now, universal life, again, is different. The only reason why somebody might choose whole life
so based on what you just said, it means that this is what I was thinking. Correct me if I'm wrong, or maybe, so if you have a whole life, when you get it, as you said, when you were building your business because you needed as a surrender to have a cash, then when you get older, you withdraw the money and buy a term insurance because at that age it will be very expensive. And then you buy a term insurance. What do you think? Is it a good strategy to have a term? Let's say you maybe 65.
At 65.
And then, yes, and then you withdraw the money from your cash value to pay a term insurance. Maybe you'll be paying, let's say, even $1,000 per month.
Per month, but you have the cash.
Yeah, and then you buy a term insurance.
Well, you know what, Harvey, I don't know because, again, I would have to be sitting with that client and see what are we trying to do here? What are we trying to mitigate? But before we go to 65, I actually would say the opposite, which is what I started is when you're still young, that's when you start to plan. And if you don't have a lot of money, let's say you are making money, you have a family, you have a mortgage to pay. If you don't have a lot of money to commit to a permanent life insurance, just do a term that will take care of everything then if something was to happen to you, and keep reviewing your financial plan every year. At some point, you and your financial advisor will be able to say, you know, Harvey, the way your business is growing and the way you are making money and the way you have been contributing to your RRSP, I foresee that we need to plan for taxes after death. And what we could do is now convert some of that term into something permanent, or all of it into something permanent. We could do that. And then that's a better way of planning. And then you can now decide, do we convert it to a T100? Do we convert it to a whole life? Or do we convert it to a universal life? And that will depend on so many things. Your risk factors, a lot of things will depend. So there is really no way to tell in foresight that I'm going to buy a whole life now, and then at 65, I will take that cash and use it. The way I see it is that if you are struggling with meeting all these bills, why pay for something that you don't even know that you will need or not?
And something's better than nothing.
Exactly. Exactly. And something that really takes care of things when they need to be taken care of. I always think about young families with spouses, with kids, and there are so many places the money is going to. And sometimes I have found cases where people are putting like $1,000 into life insurance policy because they are running after the cash value. And then eventually they are asking for premium break, and they are asking for this. If you are doing that kind of thing and you are doing it because you get premium break or you get cash, there's so many ways to invest money. And life insurance policy is like the last resort.
And regarding the age, when you were talking about being young, what age are you thinking of?
So young is when I meet you. So when I meet you the first time as my client, I'm like, you know what, this is it. We start where we are. However, I do like I have my own, like I showed, I have my own kids. Both of them have finished school. I started doing financial planning with them as early as I could. As soon as they get their first jobs, I'm looking at their benefit plans. I'm looking at what are they committing at work. Are they participating in the pension? Are they contributing to the group RRSP? Do they have a life insurance? Is it a term? Is it this? Are they buying a houses? So young is like that. And then at 30 is still young. At 40 is still young. Then I will meet people who are very close to 65. Yes, it's young, but these people are really staring retirement so close, right? But it's still young, as opposed if you met them when they are already retired and they don't know what to do. So it's relative. So when I say young, it's relative, but I do like to start very, very, very early if I can. But when I meet a client, that's the earliest I work with them, and I work with what they have. I did not go into specifics because it's complex. It's complex, it's complex, it's complex. Taxes, while we are living, are already complex. So imagine when after somebody dies. So planning is the most important thing, but also the most important thing is to work with somebody. And that's why I am passionate about my work, because I have known that most people of our African descent, immigrants, you know, we are working hard, we come here, we work, but we don't have anything left to pay for a financial planner or do this. A lot of wealthy people, they pay for financial planners. Other people, they just say, you know what, I can't afford. And yet they are the ones that truly, truly need it. So I do not charge for fees to do financial planning for Canadian families of a certain income bracket, because I have realized that these people need it the most. And so one of my passion is to give my services and get paid in other ways. So even something like this, I love spending my time educating people like this, because I know I may just change one person, but that's worth it. Somebody who will say, I need help, go to your financial advisor. You don't have to come to me, but get somebody who will sit down and figure out what is unique about your finances and work with them every single year to plan your finances.
I agree, and thank you. And I think that we should get your business card so that whenever we want this kind of information, DDI or the other members can contact you and share your wealth of knowledge. Merci beaucoup, c'est très éclairant. C'est très intéressant et je pense que DDI et nous les membres, on en profiterait pour contacter des professionnels comme Madame et nous éclairer sur des points aussi complexes qui sont la taxe, parce qu'en taxe, il y a plusieurs niveaux, il y a plusieurs genres de taxes Et ces connaissances peuvent nous aider. Merci.
Et c'est exactement, ça va en droit de ligne avec ce que tu disais hier, Georges, dans la mesure où on a des experts dans la communauté, on n'est même pas au courant de leurs compétences, alors que juste en cognant des portes comme ça, voilà, on est éclairé sur beaucoup de choses, parce que moi, personnellement, j'ai beaucoup appris. Je suis extrêmement édifié par cette présentation. Vraiment, merci encore au gouvernement canadien de nous avoir permis d'avoir ces ateliers, quoi.
La présidente est la chargée de projet.
Oui, la présidente est la chargée de projet, vraiment.
Un beau travail.
Merci encore et grand chapeau.
Ouais.
So, Esther, we come at the end of the presentation. I still have another question, but I don't want to take the time. We might discuss that later on. So, on behalf of DDI, I want to thank you very much for being here today. As you see, people are here because we like, whoa, okay. Even me, I learned a lot from this workshop, and hopefully we'll be getting the funding from the government to continue doing this. It's very useful. Yeah, so...
Je voudrais juste mentionner que qu'elle sache que sa vidéo sera disponible pour nous, afin que les membres qui n'ont pas pu se joindre, parce qu'il y en a plusieurs, vont pouvoir visionner après également pour être édifiés sur les taxes.
Oh, just in case I didn't introduce you to our president, Henriette is our president for DDI from North America to Europe. So she's the one managing us.
Wow.
Yeah. So she was saying that this video, because it was recorded, right, will be available to our members that couldn't attend to this session, so that you have to be aware that, because don't be surprised you see that on YouTube or wherever or any other platform. So that is one of our policies to make it available for our members who are not present in the workshop.
Absolutely, absolutely. Yeah. I just want to say thank you so much for inviting me and giving me the opportunity to do something that is very close to my heart. So thank you so much and very nice to meet you all. Congratulations on the good job that you're doing. Keep it up. Keep reaching out to Canadians, educating, and it's really important. So thank you so much.
And we hope that we will join the platform of DDI pretty soon. Even the Marafiki one, we're hoping that you will spread the word in your community. Yes. And then, because many of the Kenyan people are part of the DDI, like all the Marafiki group, even back in the East, they have a very large group that are planning to join the platform. So
nice. Excellent.
Other than that, I'm going to wish you guys a wonderful long weekend. I think this is the long weekend. Enjoy you guys' families, and hopefully we'll be meeting